we move to the economic rubric, and the economic rubric issue 4, under the economic rubric, issue 4 is increasing strains towards global recession. Now, here we are being a bit contrarian. The US Treasury Secretary, Scott Bessent, has said, I think 2026 can be a very good year. The One Big Beautiful Bill Act, a wonderful name, a glorious name, the best ever that you can imagine, is a tax-cutting law enacted in July. It'll soon have effects. Americans will receive refunds that reflect retroactive tax cuts on income from 2025. They will also find that levies on monthly earnings have fallen. According to Piper Sandler, an investment bank, these 2 years of tax cuts in one are worth about 191 billion. So you'll get a big fiscal cannon going off. Not just that, a monetary cannon is also likely to go off. In 2024, the Fed cut rates thrice. In 2025, the Fed held its fire or didn't drop rates, despite pressure from Donald Trump. But in September, October, and December, the Fed has cut rates this year, and it has cut rates to limit job losses. Over 1 million people lost their jobs in the worst year for layoffs since 2009. So I was looking at some numbers, and I was looking at numbers for layoffs by year. And in 2020, over 2 million people lost their jobs. In 2001, nearly 2 million people lost their jobs. In 2002, the number was 1.3 plus 1.373, or basically nearly 1.4 million. In 2009, it was over 1.2 million. And in 2025, when we've not had a financial crisis, unlike 2007, 2008, we've already lost nearly 1,171,000 jobs. That's a big figure. Despite that, the GDP is soaring, and it rose 4.3% in the third quarter. Goldman Sachs expects, quote, sturdy global growth of 2.8% in 2026 versus a consensus forecast of 2.5%. The US is likely to outperform substantially, 2.6 versus 2%, unquote. So basically, Goldman Sachs expects slower but solid growth to continue in 2026 because of 3 reasons: reduced tariff drag, tax cuts, i.e. fiscal policy, easier financial conditions, i.e. monetary policy. And the Goldman Sachs estimates for the US economy, quarter 1, 3.5%, quarter 2, 2.5%, quarter 3, 2.1%, quarter 4, 2.1%. These are its forecasts for 2026. Now, the Fed will have a new chair in May, and it's likely to be someone Donald Trump likes and US Treasury Secretary Scott Bessent likes. So we are probably going to have a looser monetary policy. So given all of that, things should be fine. I mean, we should carry on. However, even Goldman Sachs foresees a big risk.
Before you get to the backside covering aspect of Goldman Sachs's presentation and assessment, listening to the Secretary of Treasury say everything will be great is a little bit like listening to a used car salesman assuring you that the car is fine. I mean, are you a fool or are you not a fool? And if you want to buy a car that makes any sense, do you listen to the car salesman or do you take it to a garage for an assessment by somebody independent before you fork over your money?
Surely Goldman Sachs is independent. Surely.
It's sort of a simple thing to do. Furthermore, the Goldman Sachs's GDP projections, I think, are quite similar to Michael Bloomberg and me. Both of us are graduates of Johns Hopkins, and between us, we have given over $100 million to Johns Hopkins University. He gave 100 million, and I've given 5. So my statement is literally true, and it's completely nonsensical. It's misleading. It's duplicitous. It's actually shameful. And we'll get to some of the, I think, deeper fundamentals that none of this seems to be touching upon. But carry on.
Well, so Goldman Sachs says the main vulnerability remains a crack in the US labor market. If job softness tips into a zone where recession becomes a serious prospect again, it's very much cover your ass territory. And we take a view more steeped in history. The big trends since 2016, since Donald Trump first came to power, are number one, mercantilism and protectionism. That is something Donald Trump has been consistent on since the 1980s when he targeted Japan. And then, of course, everything he said about Japan, you could just replace Japan with China and add a little bit more.
That is literally a true statement. That is not, you are not being in the least reductionist or facetious. That is literally true. You change the word Japan to China or Europe, and you change the date, perhaps, and it's what Trump says is verbatim what he said in the 1980s.
So number one, mercantilism and protectionism. Number two, tax cuts and rising deficits, which, shall we say, are also lead to rising debt. And American debt as a percentage of GDP is exceeding Greece's. So worrying trends.
And lead to rising interest rates.
Yes.
And lead to lower growth.
Yes. And number three, monetary pump priming through basically using both monetary and fiscal levers, because it's the midterm in 2026. We are seeing a return to pump priming, which many governments practiced, particularly in the aftermath of World War II, until the 1970s, when you had a move towards independent central banks and economic governance that was less timed according to election cycles. Number four, more mergers and acquisitions than previous years. Number five, increased market distortions. Number six, a K-shaped recovery. And those of you who know about a K-shaped recovery, I mean, the upper classes or the wealthier sections of society experience a boom, and those at the bottom have a drop off. That's a K-shaped recovery. Now, we don't have time to dive into this in detail. We'll do it in a deeper podcast. Listen to the dialectic, where we cover issues in much greater detail. But the important thing is that all of these will combine to slow down growth, and all of these will cause the risk of recession to go up. Now, important thing to remember here is that let's touch upon a couple of data points very quickly, and then I'll hand it over to Glenn. According to the Harvard Law School Forum on Corporate Governance, the 2025 M&A deal volume in the US reached approximately 2.3 trillion. This is up 49% from 2024. And the global M&A deal volume is expected to increase by over 25%. So we've had very large M&A deals in the US, $40 billion plus deals to date, and there were zero such deals in 2024. So what we are seeing is this reemergence of the mega deal. And that is always a worrying sign of a frothy market. That means that the animal spirits have gone a little too crazy. Now, worldwide, there were 63 deals worth 10 billion or more. This exceeds the prior annual high set a decade earlier. Global private equity deal volumes reached 2 trillion by the end of 2025, a high since the banner year COVID era 2021. So there are fears that the market may be a little too frothy. There are fears of an AI bubble bursting. there has been $350 billion of capital expenditure in AI. 100 billion of this is debt. This is 3 times the average of the previous 9 years. There have been incestuous circular deals. What do I mean by that? NVIDIA invested in OpenAI, then OpenAI bought NVIDIA chips for computing power. This is a little too incestuous. Valuations are looking expensive. The S&P is trading at 31 times earnings. This PE ratio is certainly not as high as the 2001 bubble, but it is getting there. And perhaps
historically, average price and earnings ratios have been about 20. So it is alarming.
Yeah. And maybe it's also, we are overdue a correction because we've had high returns for 3 consecutive years, 24% in 2023, 23% in 2024, and 17% in 2025. The fact that the music, the notion that the music will keep playing seems to be slightly optimistic. One of our friends, in fact, we have many friends who are investors. Our editor-at-large, Alex Gloy, a German economist, has been one of our friend philosophers and guides, helps us come to better judgment. But this is not his remarks. This is another savvy investor. He said, fine, you're investing all of this. Where are the new business models and the flowing revenue streams from this new AI? Also, in November, both Glenn and I raised this issue and pointed to everyone that bank bosses to IMF economists are warning about stratospheric valuations of America's tech companies. For instance, for companies to achieve a 10% return on AI capex by 2030, they will need 650 billion of annual AI revenues. This is close to $400 per year from every iPhone user. So the US economy has major risks. Things are not looking good. And we are seeing job losses, and we are seeing dangerous fiscal and monetary loosening. Other economies also face risk. Chinese factories are running far short of capacity. Demand continues to be weak. Unemployment remains high. EU economies with aging populations, low demand, high unemployment, large debts, and low productivity face crisis. The Indian economy, and we'll do a podcast on this shortly, faces meltdown because of a new form of socialism. Extreme oligopoly and tax terrorism. If you pursue any economic activity now, the government may just fleece you. And so even though India has cheap labor, the cost of doing business, the transaction costs are so crazily high that you're better off going to Vietnam or elsewhere. So manufacturing in India has cratered, and so has demand, and talent and capital is fleeing India. So if you start looking at the big drivers of the global economy, the question arises, where will growth come from? Over to you, Glenn, after such grim news and so many bad numbers, and what do you have to say?
I think the numbers are worse than what you've been saying, because what you've been saying just now, not that you were wrong, is that you have been iterating for us what the government officials, in particular in the United States, have been saying about the rosy economic circumstances. The facts, I think, are substantially different, or the understanding of them should be substantially different. So the stock market growth, most of us probably have heard, if not, we all should, that I believe 60% of the stock market's increase, is because of the 5 AI leading investing research companies. For the rest of the market, the Standard & Poor's 500 in the United States context, the market has been essentially flat for several years. When you look at unemployment being still low, and I'll take the counter position to your enumeration of the annual job losses is that there have been job creations at the same time, and unemployment remains low. But I don't think that is the leading indicator. That's the indicative data point we should look at. What we should look at really is that we should take a lesson from orchard growers in Western Massachusetts in 1981. I'm sure you all are intimately aware of that story. The story is that Massachusetts doesn't have much agriculture compared to states where that's more central for their economies, but it has some. It has apple orchards in the west of the state. In the fall of 1981, it was harvest time, and the apple growers needed labor to pick the apples. And unemployment at the time was something like 13%. I don't know. It was very high. And they could not get Americans to accept the jobs. So they had a choice. Either the apples rot and they go bankrupt, or they find labor somehow. And what did they do? They literally flew in Haitian day laborers who were willing to work. And that saved the orchard and the harvest and the jobs at the cost of low-cost immigrant labor. What's happening now? Illegal immigration is really is the lowest that has been in many years. One can praise this. But the reality also is that 40 years ago, it was actually 44 years ago, when the last close call for reaching an Immigration Reform Act occurred, the deal was scotched by two factions, one Republican and one Democrat. The Democrats insisted that there be labor guarantees for all employees, whether they were legal or illegal, and the Republicans refused that. And the Republicans insisted that there be exceptions made for day laborers to support the agricultural industry of the Southwest of the United States. And so there was no labor immigration reform, so that immigrants could continue to pick the strawberries and Americans could have low-priced food. All of that is changing now, but you will not have as labor conducted at as lower cost, so that will be inflationary, and you will struggle in America to find enough hands willing to do the jobs that now are not being filled. So the pressures on employment are contradictory, but they will be inflationary, and unemployment will go up because interest rates will go up as the deficit is increasing, which will crowd out opportunities for expenditure by the government at the same time. Furthermore, these rosy GDP figures that are given are quite misleading, because where is literally the overwhelming majority of expenditures coming from? It's coming from the top 5%, even top 1% of the economic structure of America, the richest
very
1
quickly,
or 5%.
If I can jump in, this is what economists call the K-shaped recovery. And what is a K-shaped economy? What is a K-shaped economy? When you have, shall we say, the top or the wealthy elements in society, when they have strong spending, they have wealth growth, and they are driving demand. But the bottom part, the lower and middle income people, they struggle with inflation, they struggle with debt, wages are stagnant, they are experiencing a cost of living crisis.
They have no money to spend.
Exactly.
They have no money to spend. And then you add to that, literally, they have no money to spend. Why was Trump reelected? He was reelected for two reasons, really. We've harped on the immigration issue, which is the social issue, one. The second one is, I think the expression used by the media now is economic anxiety. It's people are feeling the pinch, and it's not the bottom 10% who always struggle terribly. It's now that the bottom is the bottom 80% of the population, which has been in economic stasis for a decade or longer. not seeing any real sustained growth in their disposable income. That is made worse. Choose one item economically, let's say tariffs by random choice, which seem to be averaging now a 15% increase across the board. The consequences are categorical. I mean, there's no debate about this unless one listens to a fool or a liar. I'm sorry. If you raise tariffs by 15%, then those products imported either will cost 15% more. I'll simplify just a little bit, or the importing companies that sell them, such as Amazon, say, will have to swallow a 15% reduction in their revenue, their profits, because they will have to pay it. Foreigners do not pay tariffs. They pay nothing. They receive income from selling their goods. So what will that have as an effect? It will increase prices. Tariffs can also have the effect of increasing domestic employment, but as those who have studied basic economics will learn, goods that have to be produced as substitutes will be less efficient, meaning they will cost more to produce. Americans will spend more money to produce a bottle of wine than someone from Portugal or South Africa, because labor costs are higher, taxes affect the businesses more directly, and so on. So you can have American wine substituting for Portuguese wine, but the cost on the whole will be higher to the consumer, which means consumers will have less money to spend in general for things, which means that demand will go down and so will the standard of living. One can go on and on and on. The point is that the economic fundamentals in the United States, and the United States remains the engine of the world economy, are less rosy and trending far worse than one hears conventionally. I am not predicting a recession in the next 6 months. But at some point, the water does spill over the top of the glass, and then you have one. And that's what I would say is happening. So to me, the consequences, I think, are that
Glenn, before you carry on, just
the global economy.
Glenn, before you carry on, just 2 data points to support you. Our sources in finance point to the Federal Reserve Bank of New York's quarterly report on household debt and credit. In the third quarter, roughly 4.5% of household debt was at least 30 days delinquent. This is the highest since early 2020 when COVID hit. In addition, student loan delinquencies jumped to 14.4%, the most on record. So what you say about people not having money is backed by this report. Over to you.
Yeah, I think we know many of us have heard the shocking statistic that I think reveals the hollowness of the richest country on earth, but of all economies, frankly, that the average American family does not have $400 of disposable income to meet an unexpected expense, such as a fender bender accident or a visit to the hospital because you stumbled on a curb and broke your elbow or something. That's a shockingly tenuous and fragile economic and social world. And so my sardonic remark about how Michael Bloomberg and I have contributed over $100 million to Johns Hopkins, it's true. What it implies or illustrates about the American economy. Elon Musk contributed roughly $300 million to a political campaign. I contributed more than most Americans, probably a couple $100. These imbalances have economic consequences, then social consequences, and then political consequences. And that's what will happen this year.
Brilliant. Okay. We'll now speed up. Issue number 5 under the economic rubric, the global race for critical minerals. Now, we think global race for critical minerals will heat up, and we think that is going to happen because China's near control over many critical minerals and rare earth elements caused alarm. Why? Because during the trade war, Beijing weaponized that dominance during trade negotiations. Both the US and the EU are worried about dependence on China and future supply shocks. You'll find talk about supply chain security anywhere you go. The US has launched a more muscular industrial policy through domestic and allied investment to resist coercion, price manipulation, and supply chain disruption. So what we expect is that starting 2026, you will see both the great powers, US and China, go head to head around the world, and others will try to secure the supply chains too. The US Geological Survey most recent list has 60 minerals and rare earth elements as critical to national and economic security. These critical minerals are often highly concentrated. So the Democratic Republic of Congo is home to more than 70% of the world's cobalt supply. So perhaps Cold War II might shift out to DRC. Similarly, Venezuela, which is in the news, has some critical minerals. And there have been executive orders galore in the Trump administration, the Department of Commerce, the Department of Defense, the Export-Import Bank, the US International Development Finance Corporation. They've all been backing development of critical minerals. And of course, the White House has pursued bilateral and multilateral agreements. And we've had deals with, for instance, Australia, and we've had the Critical Minerals Action Plan agreed at the Group of Seven Summit in June. We've also had the Quad Critical Minerals Initiative, and so on and so forth. Over to Glenn for consequences and forecast.
Well, I guess the rare minerals are today's version of oil, I suppose, or uranium. Oh, that's a rare mineral. And it can drive geopolitics and certainly shape the economy, and pretty well guaranteeing clashes. But in any event, these two lines of effort, I think, will continue to shape the Trump administration's and China's, therefore the world's diplomacy and industrial policies this year. How this will affect overall supply and therefore the growth rates of the cutting edge industries, I think is uncertain. I'm relatively optimistic that demand will find greater supply if China restricts it. That's historically been the case everywhere. We're hearing of
especially over time,
discoveries in lithium in Latin America. But certainly it's one of the driving forces, it will be, for 2026, economically, politically, geopolitically, and politically in domestic context too.
Join the conversation at Fair Observer and subscribe to our YouTube channel.